Hi there. If you didn't know, my name is Sierra Marquis. I have a Master of Business Administration degree and I went to school so you didn't have to. Okay, so today we're going to talk about the income statement and we're going to find out how to calculate the income statement and why the income statement is important. So the income statement is important because it lets you know how cash is flowing in your business and how cash is flowing out of your business. It tells you exactly how much actual cash you have on hand, okay? So you begin with your total sales, okay? And first, we're going to calculate the cost of goods sold. The cost of goods sold is the beginning inventory balance plus the cost of either buying merchandise if you're a retailer or manufacturing costs if you're a manufacturer. We're going to add those two together. The total gives you the goods available for sale. Now, we take the goods available for sale number and we subtract the ending inventory for that period covered, okay? Once we do that, we get something called a gross margin. So the gross margin is that the number we just calculated, okay? And it's divided by the difference between total sales and gross margin. Okay? So if you take total sales, you subtract okay, let me start over. Gross margin, you have that number, okay? That's because of all the calculations we just made. Okay? You're going to take that number and you're going to subtract it from total sales. Then you're going to take the difference and divide gross margin by that difference, okay? Now that we're after gross margin, you subtract your operating expenses. Operating expenses, of course, as we've already talked about before, are your selling and administrative costs. So after you subtract that, now you know how much actual cash you have on hand at your company. And it's important to know how much cash you have because say you needed a loan, right? When I had to get a loan for my mortgage, I had to prove that I had cash flow, enough cash flow to get approved for that loan. It's no different for businesses, okay? That business has to prove that it has positive cash flow and enough cash flow to pay its bills over a period of time. Now, that percentage, that gross margin percentage, it gives you a quick little snapshot as to how your business is performing. And the reason why, another reason other than cash flow, why you need to know that is because if your gross margin percentage is constantly increasing, you need to figure out why. Okay, obviously you're selling more stuff, but why are you selling more stuff? And if you are selling more stuff, is it time to expand? Do you have enough cash on hand to make your business bigger? Okay, so that's the income statement. It's super simple to calculate, and yeah, you have to know how much cash you have. Okay.